Alright, other real estate contracts, Chapter 12. Essential matters to learn from this chapter. Contract for exchange used when property owners agree to swap property to property for the same in nature for the exchange, such as real estate for real estate, are called like kind. Because it would be unusual for two properties to have exactly the same value, most likely one owner will give something the value equalize the value of the exchange, so that other unlike property is called the boot. Boot may cash, furniture, car, diamond, or anything else with value. Relief mortgage debt is also boot received. In exchange, business, investment, real estate may be tax deferred under Section 1031 of the Internal Revenue Code. Tax deferment under Section 1031 does not apply but the only personal residence. One's personal residence with preferential treatment under the different section of the Internal Revenue Code. Tax deferment means a gain realized will not be recognized taxable on the exchange at the time of the potential gain of the taxable and later transaction. Tax deferment does not apply to unlikely property received. The boot tax must be paid on the boot received to the extent of that there is gain. When one or both the properties is mortgaged, the fairness of the exchange is based on the equalizing equity value, market value minus debt of the properties. One need not exchange property simultaneously for the gain to be deferred. A tax deferred exchange always whereby after sale seller identifies the limited number of the possible substitute like-kind properties within 45 days close within 180 days of the sale. Contract of the deed is used when seller finances a sale or resale but does not give the buyer's title. Final payment is made. The common method of selling resort vacation property. Another name for the contract or for the deed is an installment land sale contract or simply land contract. An option is a contract that gives a party the right to buy what is within a certain time, but no obligation to buy. Landowner is called an optioner. The possible buyer is the optionee. Optionee may buy before the option time period expires, but not obligated to buy. The option is considered unilateral control. Is called a unilateral contract, not bilateral, because only one party, the optionee, can act. If the optionee decides not to buy with the amount paid for the property owner of the option is forfeited to the owner, the optionee does buy. The option price may or may not be applied to the purchase price depending on what it was written with the option contract. Purchase price should be stated in the option as an initial negotiation. An assignment is a contract when another person accepts the obligation of the contract. An assignment does not release an assigner, the one who assigns another from the original contract. To release the original party with the contract substituting another person requires a novation. All parties must sign the novation. Release one party with the contract substitutes of a different person. People dealing in real estate may want to accomplish transactions that do not involve the category contracts and discussed in Chapter 8 through 11. In this chapter, you will learn about other types of contracts, including contracts exchange for the real estate, contracts with deed, option, assignments, and notation. Or contracts for exchange. Even the principal would exchange for the property. You may wonder why people would want to swap their real estate, but there are peculiarities in the U.S. Internal Revenue Code that confer tax advantages to some of the kinds of exchange. However, these advantages are available only for the investment property held with rental income property used in one's business. Therefore, people who exchange homes that they live in their residency can use the tax breaks. Those who sell their own homes are offered different tax breaks. A resident broker salesperson, one who focuses on housing, is unlikely to encounter exchange transaction. And both properties are agreed by owner to be of equal value but are unequal and encumbered. They may be swapped without additional consideration. Transaction may be beneficial to principal. For example, one person may own land and want to income producing property, whereas the other person may have the opposite holdings and needs. Swap accomplishment the objective of both parties, even though the property exchanges are worth more now than they cost originally. More often than properties exchanged are a different value. The party who gives up the lower value property must also give the other consideration. Trade becomes fair, one acceptable to both parties. Personal property, car, cash, diamonds, etc. put in exchange to equalize the total value of all the property exchanged is called the boot. The party receiving the boot be taxed extent with the unlikely property the boot was received itself. If less, the gain realized. Unlike property real estate exchange transaction, anything that isn't real estate like-kind property is real estate. The tax advantage only applies to like-kind property that is exchanged. Mortgage property can be exchanged. Suppose Mr. Jones owns $10,000 vacant lot free of clear. Mr. Smith owns $50,000 building with a $40,000 mortgage against it. Since the equity both is $10,000 exchanged to fair trade, Smith Boot received a relief from a $40,000 debt deferred delayed exchange are allowed under IRS Section 103(1)(c), pages 340 and 343, which require identification of limited number of possibility requirement possible properties within 45 days of sales closing. One elect selected within 180 days of sale. There are some other rigid requirements. Years ago, simultaneous exchange was required for income tax purposes. Some of the same broker might have been involved with the buyer and seller, possibly presenting a conflicting situation, which why such dual agency is now legal in many states, and deferred exchange, which is current norm. The broker of the sale and the broker of the replacement property are likely to be entirely different people. It's unlikely that the same broker would be called on as an agent, parties of conflicting interests. Contracts for a deed. A contract for a deed, also known as the land contract or installment land sale contract. The property is presented to the seller finances for the sale, but does not surrender the deed until all payments have been made. The type of the contract typically allows the purchaser to gain possession, but not ownership of land while paying for it. Because the selling retains the deed until the final payment, he is well protected in the event of default. In many states, because the land is still legally his, he doesn't have to go through foreclosure. He can have a defaulting buyer evicted quickly and regain full possession and ownership of the land, even if the states where foreclosure is required under the contract of the deed procedure. Often is less time consuming and expensive than it would be for a seller were foreclosing a mortgage. Contrast to the deed, also known as the land contract, installment land sales contract, is frequently used for sale of the subdivided land, especially in resort communities. Option give the holder right or not obligation to buy the specific property within a certain time and specified period price. The option need not to be exercised. An optionee can elect not to purchase the property, in which amounts paid to acquire the option belong to the property owner, which is the optioner. Consider must be paid within an option. Upon exercise of an option, the amount paid for the option may or may not apply to the sales price, depending on the agreement. Option may be used to speculate over the uncertain whether the significant increase of the value of the property is forthcoming. Through purchasing in the option, she can assure the fixed price of the property's set time span. If the value increases materially, she exercises the option. Otherwise, she is elapsed, loses only the cost of the option. The holder of an option may sell the option itself as gain or loss. If she wishes to do so, find the buyer. Assignments. Assignments refer to transfer contracts. Those assignments a person may convey, but someone has the right. Someone has the right under the contract of lease, may be assigned as may be the contract sale of the deed option, so on. The person who gives the assignment of the contract is the assigner, the receiver, the assignee. Should be noted that the assigner is not automatically relieved of the duties to the other parties under an earlier contract. The lease contract exists and assigned. For example, the original lease is still bound to pay rent for the assignee fails to do so. Novations. A novation is a contract either to substitute with a new contract, existing contract between the same parties, is either to substitute with replacing one party with a contract with a different party. The novation is used to amend the agreement of the substitute parties involved. Novation but must be bilateral. Both parties must agree. Suppose home is to be sold when the buyer, assuming the seller mortgage, since the seller made the contract to repay the debt, she cannot automatically substitute with a new buyer for herself on the debt. Acceptance of the substitution must come from the lender. The process of the substitution is called the novation. In such case, the original contract has been assigned, while at the same time the assigner has been relieved of her obligation to the other parties of the contract. That was the end of Chapter 12. Part 4, Real Estate Analysis.